What is up, world? It's your boy Tanh, and you are listening to the Wonton Wealth Podcast. Here, I'm going to unravel anything and everything commercial real estate related. And more importantly, we're going to add abundant value. So if you're ready, buckle up your eardrums. What's up, everybody? Welcome back. Today's episode is going to be a little bit different. It is going to be tailored to retail commercial assets. So my buddy Alvaro, who I met at the Best Ever conference roughly 2 years ago, reached out to me, wanted to learn a little bit more about retail as an asset class and how we generally just evaluate them. Him and his co-worker at Eisenberg reached out and wanted to learn, so I essentially recorded the conversation and figured it would be beneficial for you guys to hear. So without further ado, here it is. Remind me, so Alvaro, you and Matt work together, is that right?
Yes, we work at Eisenberg and Company. I've been at the company now for a little over a year. Matt, you've been at the company for a little over 2 years?
Yeah, coming up on 3.
Yeah. Coming
Very
up on
cool.
3. And our job is to help middle market real estate sponsors capitalize their projects both on the debt and equity side. We are not a broker dealer, so we can't call it equity at the fund level. We can raise equity at the asset level. And the exception we have from being a registered broker dealer is we're only bringing in one institutional equity investor. So we'll bring in Sculptor Capital Management. Sculptor is let's say 30 billion plus multi-fund manager out of New York. One fund vehicles would be dedicated to real estate, and they would invest equity into deals. Typically, these equity investors are looking for a minimum check size of about $10 million. So they have to be pretty sizable deals. And we target deals from 15 up, total deal size from 15 to about 150 million. And the average deal size is probably in that 15 to $30 million range.
Gotcha.
And the example would be like this deal that I mentioned outside of San Antonio. They've done a few deals in the past and they're looking to do something bigger. It's a ground up construction deal. They need debt to fund the construction, and they're also looking to reduce their equity requirement as much as possible. So we're also helping them find preferred equity for the deal.
Gotcha.
We'll go out and reach out to our database of lenders. In an ideal world, create a market for him. So you have ultimately 2 or 3 lenders competing on the deal, and we're able to get them the highest amount of proceeds at the lowest costs with the best structure. And the same thing on the equity side. We tend to be more selective on the equity side. There is not much of a universe right now for institutional LP or common equity. A lot of them have gone into more preferred equity positions, but even then, very selective. Why? Because you can lend and earn a decent return, say like SOFR plus, 3 to 700, or you can take equity risk at a higher leverage point. So say the debt goes up to 70% loan to cost. Equity has risk above 70, and the risk reward profile is not that great given the market. Either costs are too high, rent growth isn't there. So equity investors are we rather dedicate more money to our debt funds than our equity funds. We still have equity money to deploy, but that's typically to repeat borrowers or repeat sponsors. So someone comes up to us and they're like, hey, can you help us raise equity? We're like, unless you have a track record in that asset class, in that market, and it's a sizable deal, we can reach out to 100 groups and they're all going to say the same thing. And that's just the market it is today. So that's what we've been doing. And Matt and I, we look at a lot of deals where we're like, this guy somehow got a piece of string and some paper clips and he put a deal together. And we think, is there an opportunity for us to potentially, when we as we build out our network, we talk to investment sales brokers, we talk to attorneys, title companies. And what if we come across an opportunity where maybe we pursue this deal ourselves and we raise capital around a particular asset and strategy? And we talk about a lot of different asset classes. I've been talking to Matt about like, hey, well, how about retail? And I realized I don't know much about retail other than it comes in different flavors. We've looked at deals that could be a grocer anchored retail space where, it's a Whole Food or a Sprouts as the anchor tenant. And then you have like the ancillary kind of or auxiliary tenants to the side with some out parcels all the way to like a strip mall in Dallas and seeing if that's a deal worth pursuing because maybe they're buying the asset where it's like 70% vacant and they know how to reposition it and fill in those vacant spaces with tenants that are earning closer to market because maybe they're like $10-15 a square foot below market. So we've been talking about retail and don't know a lot of people that operate in that space. And I thought of you and
Oh, thanks, buddy.
thought you could share, I guess, your story, where you got started, where you're at today, what your portfolio looks like, and your sense of the market. And then that could segue into how you evaluate opportunities. Like, what are you looking for in a deal? And I can send you a link to one where it's like it's a strip center here in Austin. It's about 60% occupied. It's near a grade school. I want to say it's a middle school. And like we come across stuff like this and I'm like, is there an opportunity to buy an asset that's less than $5 million, reposition it in some way, and refi at some point after we've created value? And hold on to these things probably over a 5 or 10 year hold.
Well, that one definitely sounds like a deal, right? So to preface this, if you guys find deals, I'm willing to help you with underwriting, looking at it, etc., right? Happy to partner with you guys as well if that's an opportunity. But to answer your first question, and I guess to fill Matt in, I actually started my career as a pharmacist. I practiced retail pharmacy for roughly 3 years before I stepped away. And I always had like this financial bug of learning how to invest, getting your money to work for you, right? And that's probably rich dad, poor dad's doing. But, I started hoarding all sorts of information, podcasts, YouTube, whatever I can get my hands on. As, when I was in college at the time, obviously as a college student, I don't know any college student that actually has money unless they're trust fund babies. So, trying to get everything for free, right? So from the investment standpoint, I was looking at stocks first and, how to make that work, how to learn how to evaluate companies and whatnot. But that slowly transitioned into real estate. So I started investing in real estate or learning about it pretty much my last year of pharmacy school, and probably why I didn't score very well in all my tests. So as soon as I graduated, making a decent salary now. So pharmacists out in Cincinnati are making roughly six figures, $120, $130, somewhere around there. And I'm sure it's fluctuated since when I was practicing. But I don't have a lot of expenses. So I cover for a family of four, which includes myself, my brother, and mom and dad, right? And we're pretty frugal. We don't spend a lot of money. So with that income, I was able to save a lot of it. And learning about real estate in general, I started buying, single families, small multifamilies and whatnot. And I did pretty much everything. I flipped, I wholesaled, I held. Pretty much the only thing I didn't do was probably note investing. So within the residential space, I grew a small portfolio with a couple partners there. And from there, I transitioned into commercial because my partners and I we were disconnected. So we essentially disbanded, sold the whole portfolio over a period of, 1.5 years or so. And from there, I transitioned into commercial. And it was difficult to transition into commercial because there was no information out there. You're searching on YouTube or Google, whatever, you only really get the rudimentary stuff, and you're getting a lot of multifamily stuff too, right? So luckily, I met a commercial investor out here who's now my mentor slash pretty much my best friend, and I learned everything I know from him with his decade and a half of experience. So you can only learn so much in a book anyways. It's the hands-on stuff that really gets your learning mode on. Right. So from there, I started looking for deals, and within my first year, I think I found 3 or 4 commercial deals, anywhere from $2 million to $5 or $6 million, right? And so from there, from the acquisition side, we just started slowly stabilizing them and working on continually looking for additional assets. So I think one of your questions, Alvaro, was what does the portfolio look like? So I tend to look at everything in the Midwest, Southeast a little bit. I avoid pretty much all the coastal states because the numbers there just don't work. right? California, New York, Florida. I'm looking in Florida, but the other state that I don't like is Illinois. So I look at states that have landlord friendly laws. Asset size is probably around 100 million, somewhere around there. And I started in 2021. My first property that was acquired was New Year's Eve of 2021. So that was kind of my first go at commercial real estate. So until now, so you're looking at, I don't know, 4 years ish. I think one of your last questions was, how do I look at deals? How do I evaluate them? Right?
Uh-huh. Just pause there. So you said the asset value of your portfolio is 100 million. How many properties is that spread across to understand, I guess,
Oh
the
boy.
operational intensity on the asset management side?
Oh God, how many roofs is that? Let's say 15 to 20 roofs. Uh,
Okay, that's quite a bit.
Square footage, I don't know, south of a million squares. It's not all retail. I look at anything non-residential. So
Yeah.
my bread and butter is essentially, I love retail and I love industrial. So those are my two main, those are kind of what I look for, right? But the portfolio has office in there, retail, industrial, medical office. I don't look at mixed use. That's one thing that I don't look at in the commercial side. So
Uh,
the was, how do you evaluate and how do you look for deals, right? Looking for deals is a multitude of things. You have to build up broker relationships, right? And obviously your lowest hanging fruit is anything that's listed. You really only have two sources for deal flow, right? On market and off market. So on market, as you guys probably know, Crexy, LoopNet are your two biggest ones. And then you have auctions. So there are auction sites out there. 10X is one of them that's owned by CoStar. And the other one is RI Marketplace. That's another big auction place. They do listings there as well. So you can look at deals, within your market area in those ways, right?
Have you bought off auction sites before on the commercial side?
I have not. We bid it on a couple, and it's a pretty lengthy process, right? You have to get
Yeah,
verified. You have to show proof of
yeah.
funds. I bid it on one probably 3 years ago. So when you go on there, you sign up and all that. You get the due diligence material. You have to really do your due diligence, right? Because a lot of times, depending on where it is, you may or may not be able to visit the site, the asset in general. So, luckily for us, this one that we bid it on was local to us. Uh, I'm west side of Cincinnati. This was kind of the east side. It was a big office park that was primarily vacant. And, so we did our underwriting and we knew, okay, if we bought this at 8.5 million bucks, it should be a good deal. So essentially we lost the bid to somebody who outbidded us. And I think we were at 8.5, and I think it sold for like 10, somewhere around there. Looking back, I mean, if we might have been too conservative on the underwriting. I think 10 still works because I drive by the property pretty often, and there's a lot of work that's been done to it. But to answer your question, Matt, yes, I've been on the platform, we've bid it, but we have not closed a transaction from the auctions.
Another reason why I was asking because I don't know if anyone knows this, but usually on those auction sites, I know for resi, you have to pay a pretty hefty I don't know, I don't know if they call it a finder's fee, but it's a fee that's really not advertised until you win the bid, and then you got to come to the term and actually close.
Yeah, so typically if you purchase a property, it's, I don't know, 3 to 6% commission fees, right?
Mhm.
And usually if a broker's involved, it comes out of the seller side.
Yep.
In the auction sites, there is a fee, and I think it's 5 or 6% of the
Okay, I
of
heard
the
it was
pro-
like 10, but
I have to revisit that. I'm not
yeah,
positive. It could be 10, but the only caveat here is that the sellers don't pay that, the buyers do.
yep, exactly.
Yeah. So the platform's got to make money, right? Looking for deals. So yeah, these are ways to look for deals, right? And it's the off market route is obviously broker relationships. You have to nurture your relationships with brokers for them to even think about you, to send you deals, whether it be off market, pocket listings, etc. But in the residential side, I don't know what you guys have heard of from multifamily and whatnot, but historically a lot of people do direct mail and cold call, right? Because all the brokers, that's what they do. pretty much day in and day out, or they have minions under them to do the cold calling. And cold calling is probably what gets the majority of the deals done. But you're probably spending 40 hours plus a week just cold calling, right? Couple hundred calls a day, etc. And it's essentially the highest ROI because it's kind of free. It just takes up your time, right? And then direct mail, letters, postcards, etc. But then from that aspect, you have to have a good database in order to get your data. If your data is shit, you're not going to get good leads. So a lot of times, well, in the residential world, you got PropStream, you got ListSource, things like that, and the residential data is actually good. However, what I've found is that the commercial data is not as clean. So if you use PropStream, if you use ListSource, that data set for commercial is not always accurate, whether it be the asset type or the owner's information, etc. So you kind of have to pay for a service that has all that data. So Crexy's the new kid on the block, up and comer, and it's I haven't played around with that data yet in terms of like cold calling, sending direct mail and whatnot. But CoStar is one of them, even though it's expensive as shit. Do you guys have access to CoStar?
We have access to CoStar.
Yeah,
And Tanh, I guess what you mentioned in terms of sourcing, kind of aha moment I had was we were helping a colleague of ours that was exploring the acquisition of a strip center in Dallas. So we realized that the sponsor didn't have the call it slash experience slash financial wherewithal to pursue the project. So he's like, I'm probably gonna have to find some sort of co-GP to do this deal with them. And I told him, I was like, dude, who's gonna be the best co-GP? Someone that probably already owns assets in that market. And you might just have to just call a bunch of people and see who's interested. So I started pulling these lists proactively just to see what that world look like. And what I realized is for retail, smaller retail, probably strip retail, if the category in CoStar had more mom and pop owners than any of the other asset classes I took a look at. So what the opportunity is you're not looking at an institutional investor. Like if you look at multifamily in most states, let's say Texas and Florida, over 200 units, the number of times you see a Blackstone or a Blackstone-like name on the property owner side is very high. But you do that for, call it below $10 million or less retail strip malls, and it's a Lee Ganesh LLC and John Smith Properties. And
exactly.
I'm like, it's like a doctor who owns like 3 of these things in the market, and that's it.
Yep.
So that was the opportunity.
Yeah, 100%, 100%. When you come across those are worth giving a call or visiting the property if you're local to it, etc. But the big boys, these funds and these REITs, they're gonna play in like the $10+ million ballpark, right? $20 million, $50 million. They need to find something to get yield for their investors, whatever it is, And a lot of times they're gonna come in with cash because they're loaded, but my sweet spot that I've seen is roughly probably $1 million, $2 million up to $8 million, because the big boys aren't buying these things. Yeah. So sub 10 essentially. So the other niche is finding something sub 10 and getting it up to 15 to sell to the REITs. So that's an opportunity. But yeah, so back to the data sourcing. So if your data is good, that's where you can use your direct mail and your cold call tactics in order to reach out to the owners. Once again, it's the same thing in the residential side, but brokers are doing this. Every broker I talk to on their lead sourcing, they literally cold call relentlessly. That's the biggest ROI, right? And it's tried and true method. So you got kind of just have to have a system to figure out how to cold call efficiently. So I tested with like VAs too, and that's a little bit more challenging. It's not as simple as in residential where everything's kind of a cookie cutter, or you have the same questions that you can ask, right? Granted, in commercial, you do have a little bit of that. You have similar questions that you can ask. However, each asset is different. And on top of that, when you're talking to a decision maker, they're kind of feeling you out as well. Are you a viable buyer? What's your asset look like? Or your AUM look like? Things like that. What's your track record? So it's hard to instill that into a VA. You can kind of smell bullshit from, you're talking to a VA, you kind of know they're not the buyer, blah, blah, blah. So then the owners will lose interest pretty quickly. So that's essentially some of the methods of looking for deals. Residential brokers are great. Commercial's not their cup of tea, right? So if they somehow get a commercial listing, a lot of times you're going to find it mismarketed in some way or misunderwritten. And properties need to be, I'm a value add guy, so I look for, mismarketed, mispriced, mismanaged, all the misses, right?
Yeah.
So, and from my experience, residential brokers they're not going to market it as well or underwrite it as well as a commercial broker who's done it thousands of times. So residential websites that lists their own listing and they're not paying for like a Crexy service or a LoopNet service to market it out there. Sometimes you'll find deals there, right? Auction sites as well. Sometimes you'll find not the big ones that I've mentioned, but smaller auction sites, like mom and pop auction sites. Sometimes you'll find a commercial property there. So secondarily, to answer your question of how you evaluate deals, it's a mixed bag. I don't have a clear-cut answer for you because every asset is different, but your main focus is retail, right?
Just I say retail just to bring some focus to
Sure,
this. I
sure.
think if we start looking at like, I don't know, flex industrial warehouses, then we're looking at strip malls. It's tough to say that we want to build some expertise around it. And two, it's hard to be taken seriously when you're like, it has a roof, right? I will take a look at it.
Yeah,
And you're right on evaluating deals. I'm not sure if now or in a second call, like I can send you the listing for the property I mentioned. It's listed for
sure.
$3.75 million. And like just walking through, hey, this is how we think about kind of tenants we would target for this based on the existing tenants. This, if we were to renovate this, maybe some exterior improvements, this is what we would do. Like signage could definitely use some improvement. This is what we would target here. And like, I don't know, just walking through your thought process there. And then I don't know, Matt, like walking through a deal is probably the best way we learn on our side when someone
Yeah,
brings a deal to
100%.
committee.
Yeah. Well, firstly, let's start with retail. And I think even if we were to talk for 10 hours, I think I can only scratch the surface of it because, you need a lot of the hands-on stuff. So the commercial side is not that much different from the multifamily side. It's just you have to bolt on a little bit other extra shit in order to get the full picture of the commercial side, right? What do multifamily guys look at? Or what does every investor look at? They look at the location. That's probably the most important thing because that's something you can't change. So, okay, now we have a location. What can we find out about that location? What are the demographics like? What's the household income? What's average median house? Things like that. And vacancy rates in the area and how many supply and demand. So what's the available square footage of retail in the area? What's the, if they build more, can that be absorbed? So things like that, all the quantitative stuff. Now on the qualitative side, you look at the asset just like anything else. What's the condition of it? Is it dog shit or is it class A? Does the roof need work? Does the asphalt or the parking lot need work? How's the HVAC? So those are the three main things I look at almost always for any asset because those are the big ticket items. If you have a shot parking lot, couple $100,000, shot roof, couple $100,000. Each HVAC unit is like 15 grand, 20 grand. So that's another aspect. You just look at it from a 30,000 foot view and then you zoom in. So let's say there's a strip mall. Okay. Now you have to put yourself into not only an owner's perspective, but a tenant's perspective. So you have to look at it. Okay, Alvaro, if you were a restaurant owner, would you put your restaurant in this strip mall? So once you kind of put yourself in that position, now you have to figure out, okay, where are my customers going to come from? Are they going to be able to see me? So visibility is going to be super important in order to draw in customers. Is there signage? Is there a pylon sign? How's the flow of traffic going to get to me? Can my customers pay for my product? So if you're selling pizzas at $15 a pizza or $20 or whatever the hell pizzas go for nowadays, can your customers pay for that? So there's a pricing strategy, etc. If you're in a high income area, okay, maybe you're able to charge $30 a pizza and people will pay for that if it's the best damn pizza out there. But if you're in a lower income area, obviously a $30 pizza is not going to cut it. So things like that. Signalized traffic is super awesome because why? If people stop at the light, they're going to be looking around and they see you a little bit more frequently than if they were just driving past. And traffic's important as well when it comes to, AM traffic, PM traffic, which direction are they going? Are they going to work? Is this commuter traffic, or is this just a super busy road? So vehicles per day, how many vehicles are going to hit this street? And obviously that depends on how many lanes you got. And then there's a service out there called Placer.ai. Do you guys use that at all?
Heard of it.
It,
Uses it uses cell phones to figure out the foot traffic, or uses something to figure out foot
yeah,
traffic.
I don't know the tech behind it, but yes, it essentially measures foot traffic. It'll tell you how many visitors that this particular location has compared to other properties or companies or businesses that are like that. So it gives you a good idea of how busy the area is and whether or not customers are in there. So from an owner's perspective, that's super important. So aside from the condition of the building and accessibility and whether or not you got the visibility, you also have to figure out, okay, does the space have enough parking for my customers? And a lot of jurisdictions are going to look at, they give a ratio out there for parking, how many parking spaces per X amount of square footage that building or property has. And generally it's around 5 parking spots per 1,000 square feet. So that's one thing. And then, once you dive deeper in, you're going to look at, what's the zoning? What's it allowed to be used for? Can that zoning be changed? Right? Things like that. So does that answer some of your question?
Yeah, no, I think it's along the lines of how I was thinking about this. A lot of the things that you touched on. It's a lot of the analysis we do for, say, multifamily projects is like, cool, you want to charge us in rent, but like, who's going to pay that? Can they afford to pay that? Why would
Sure.
someone choose to live here? Is it because it's down the street from where they work? Is it down the street from a really good school and that's where the parents want to live close to that school? Does it have a lot of retail restaurant down the street? And you're like, well, when I get home, I want to be able to go grab a bite and that's why I want to live there.
Right.
So a lot of the same questions where some of my thinking is now like, say in this particular asset, rents go for like, 30 plus a square foot and they're currently charging in the low 20s. How much money do you spend to be able to realize that bump in rent? How would you think about that TI improvements? How much do you provide? Are you looking for a payback period of like 3 to 5 years or like half the term of whatever the lease is? So if it's a 10-year term, tough to get it for like these kind of tenants, but like, let's say it's a 5-year lease and then you get paid back that TI in like year 2 or 3. So you have 2 years where you're now in the green or in the black. Try and figure out that analysis. And then, how I've been thinking about this is, do you build relationships with like tenant rep brokers that will understand, I know someone that could be a great fit for that particular space. This is what they're looking for. So
Yeah.
also like the relationships that we should be building as we're looking to pursue some of these assets.
Yeah, absolutely. So obviously the rent rate is a big factor as well, right? Kind of like you mentioned, if you know what the market is charging and they're under market, there's potential value add there. However, you also have to consider the type of asset. Is it a class
Yeah.
A, class B, class C, right? So obviously class A, you can charge higher on that spectrum, whereas class B and C, you can't do that. And now you also have to look at, so the other aspect too is now you have net leases versus gross leases.
Mm-hmm.
So obviously a national tenant, they're going to be used to a triple net lease or an absolute net lease, whatever your asset type is. Whereas a mom and pop tenant, it's going to be harder for you to get to that triple net. It's a lot of explaining to do. Now it's like, it looks like a fee to them. So you're probably going to get more gross leases with mom and pop tenants or modified
Okay.
gross leases. So now that's kind of when you do the underwriting, that's going to come into play, because if you're looking at an asset that has all mom and pop tenants, obviously it's going to trade at a higher cap rate versus a Starbucks or a McDonald's or one of these national retailers. It's
Yeah.
going to trade at a lower cap rate because there's a lot less risk to it. They're not going to default. So things to keep in mind. Now, when it comes to TI, there's a few things that you can do. But then again, that kind of comes back to who you think your clientele is when it comes to the tenant side, right? Am I going to be marketing to a mom and pop tenant or a national tenant? So mom and pop tenants, generally, they don't have a lot of money, not a lot of reserves. So a lot of times for you to lease out your space to them, you might have to put some money into your space, whether you white box it or spec it out to their configurations. Now, with larger tenants, national tenants or credit tenants, they're going to have a little bit more money to put into a building. So a lot of times they're going to ask for, they also have negotiating power. If you want me in here, I'm going to need $1 million in TI.
Yeah.
So it's always going to be different depending on your space. And I'll give you an example. The strip mall that I have still, that had a 30,000 square foot vacancy. Those are a little bit more challenging to lease out because who's going to fill 30,000 squares, right? So when we had it marketed, we had Grocery Outlet interested in the space. They needed close to $1 million in TI, but their lease rate was probably at market. So it was one of those where it would have took probably 3 or 4 years before you even make that $1 million back. Just from the cash flows that they're paying you. But if they were to come in, your cap rate now compresses a little bit. So you kind of get that value again on the sale side. So you kind of have to evaluate whether or not that $1 million is worth it for your sale and when you recoup that money. So we denied that LOI. We denied that deal. Riley's came in and they wanted the 30,000 square foot space plus the 6,000 next to it. Their asks from the TI perspective was very little, broom tight, watertight conditions, etc. Just make sure it's functional for us, get your shit out of there, make sure everything's working for us, done. So in reality, we might have spent, I don't know, 20,000 or something just to get the space kind of ready for them. And they're going to be pouring in probably like $2 million into this space just to get their space ready for them. And that was a better deal to us because we're not throwing out $1 million, right? And we still get a similar cap rate compression. So when you underwrite, you kind of have to figure out, okay, should I white box it? Should I leave it? Or what? I generally put a kind of a dollar amount in there to renovate the space, right? Okay, so if you're just white boxing it, you might be looking at, I don't know, 10, 20 bucks a square foot to get it cleaned up, somewhere around there. Probably less depending on your, more depending on your market. But like if you really are doing a full out TI build, it's going to be higher than that, $100 a foot maybe, somewhere around there, 50 to 100. So it's a difficult question to answer because it depends on your tenant. And every deal is different. They're going to negotiate this, negotiate that. So if let's say they ask for $500,000 in TI, I might be like, we'll give you $2 million, So there's not a real barometer to kind of spec that out, So the other thing is, how do you build that into the rents, right? So a lot of times you can increase your rent and amortize that TI out so that so it's essentially you giving them a loan for their TI build. So you're going to charge them a base rent plus nets, and then your TI is kind of amortized over however you want to schedule that. Right? Sometimes you don't get that luxury. Sometimes it's just, I give you the TI, you come in, you're my tenant, great. And a lot of times if you're savvy, you're going to try to get that TI money back in some way, shape, or form. So does that kind of answer your question? Can I elaborate anymore?
It does. And then that's where I was like, like how do I inform myself on the tenants that would be attracted to this particular space? And that's why I was like, oh, do I need to build a relationship with someone tenant rep side to understand their existing clients? What are they looking for? Let's say, I have a 2,000 square foot suite located in this particular submarket. Who would be interested in this? Hey, and it's, by the way, it has proximity to a school. So like one of the existing tenants right now is like a music school. I'm not sure if, kids leave school and then they get dropped off at the music school, so they have something to do while their parents are still working, that kind of thing. And it's right across the street. So how do you build complementary tenant mixes where you don't have too many of them just competing against each other and you have a bunch of different businesses? So yeah, it was a lot of that. It's like, okay, who would actually be interested in this? And without me knowing, like, let me just tap on the shoulder of an expert and be like, hey man, what are you seeing in this market?
Yeah, so with spaces, right, you also have to look at the configuration of your space. Is it, what size is it? How's the flow going to work is it a square? Is it long and narrow? So
Long and narrow.
Long and narrow are tough because if you think about it from the customer's perspective, you walk into a long and narrow spot for a retailer, let's say they sold like a TJ Maxx. If it were long and narrow, it would be a nightmare for you to fight with all the other customers to get to where you're going. So a lot of times they'll just stop and kind of look at the front of the space versus everything in the back. So My point is with the space is that if it's sub 10,000, you can kind of market that yourself. Do what the brokers do. Put up signs for lease, Facebook Marketplace, anything on the internet. And you can cold call other places around, see if they're expanding, downsizing, etc. But now once you're over that 10,000 square foot space, and it's probably 8,000 or something, but once you're over that threshold, it becomes a lot more challenging to find a tenant to fill that space, because your mom and pop or smaller tenants they're going to utilize help in order to find the space that they want. And that's where your tenant brokers come in. So like a 30,000 square foot space, there was not a chance in hell I would be able to get that leased out by myself. And that's where they come in, their expertise with their network and all their years of cold calling, etc. They've built up a Rolodex of all those people. So, if it's, once again, if a space like that is long and narrow, when I underwrite it, I kind of put that as dead space. You might be able to get somebody in there, but it's challenging. And that's a wrap. If you've made it this far, that means you've listened to the entire episode, so thank you. I hope you enjoyed it, and if you did, please leave a review on Spotify, Apple Podcasts, or wherever you're listening from. And if you've learned something or found it useful, share it with one of your homies. And if you want to get in touch with me, I'm pretty active on IG. My handle is pro_TANH. Reach out, let me know what you liked, what you didn't like, or what you want to hear about in the future. I'm here to tailor this to you. Until next time.